Welcome and thank you for joining this Each One Teach One financial literacy series video where we will discuss loan costs and obligations. My name is Nikki Vandenheuvel and I am a Learning and Development Coordinator with Fusion Credit Union, as well as a certified Each One Teach One financial literacy coach. Fusion has partnered with Each One Teach One as a way to provide our members with financial education options so that they can confidently manage their finances. Today, we'll take a look at the costs and obligations of loans. Many of us make the largest investments in our lives by borrowing money. This can be a scary prospect, but there are ways to borrow money safely and responsibly. Credit has both advantages and disadvantages. By using it wisely, we can benefit from the advantages and reduce the disadvantages. Although there are many reasons to borrow money, and certainly many reasons we might find ourselves in need of money, there are, financially speaking, only a few sound reasons to borrow. First, to make an investment. This can include buying a residence or rental property, education, purchasing tools, equipment, or a vehicle for a job, investing in an RSP for retirement, or investing for higher returns. Secondly, to reduce interest payments, to simplify payments, to get out of an emergency situation, and lastly, to build your credit history. Just as there are good reasons to borrow, there are also times when borrowing money is not a good idea for your long-term financial health. It's generally not a good idea to borrow for the following reasons. First, to engage in uncontrolled spending. If you are borrowing money on your credit card to buy consumer goods that are not needs, like new shoes or a new TV or the newest phone, you may find yourself in a difficult financial situation. Before you borrow to buy consumer goods, consider your wants versus your needs. Secondly, to pay monthly bills. If you aren't able to cover your monthly obligations, borrowing more money will put you in a more difficult position as each month passes, unless you reduce your bills. 3. To pay outstanding debt. If you're struggling to pay your existing loans, borrowing more money can easily put you in an even worse financial situation. There's one exception to this rule, which we will talk about a little later, and that is consolidation loans. 4. To borrow for someone else. It is one thing to co-sign for a loan, but you should never borrow money for someone else. If that person is unable to pay you back or decides that they simply don't want to, you may be left to make payments on a loan that you might not be able to afford. And lastly, to make risky investments. If someone offers you a great deal where they guarantee you will make money, be very cautious. Borrowing money to invest, even in the stock market, can be very risky. In order to borrow money, you will need to meet several minimum requirements. Each financial institution has similar but differing requirements that you will have to meet in order to qualify for a loan that include the following: a good credit history, a stable source of income. You may be asked to provide a letter of employment, pay stubs, proof of rental income, or proof of pension, as well as the CRA notice of assessment. Other minimum requirements may include a discussion on your assets and liabilities, otherwise known as your net worth, an interview on income and expenses, and lastly, a discussion surrounding collateral. So collateral is something pledged as security for repayment of a loan that will be forfeited in the event of a default. Some additional things to consider: when you are meeting with a lending specialist, be prepared to answer many questions. The more they know, the more they'll be able to help. Again, they may ask you to come back with more information, such as an employment letter, pay stubs. This information helps the lender verify the information you've provided and helps them make sure that you are able to take on this debt. Just as everybody's financial needs are different, so are all loans. Whenever you are offered a loan, examine the details of the loan carefully and make sure that the loan is the right one for you. To determine this, you should answer the 5 following questions. What payment is comfortable? Can you afford this payment? Would you be able to afford these payments if your financial situation changed? 2. How long will it take to pay off this loan? Can you pay the loan biweekly, for instance, on your payday or the day after your paycheck? This can help reduce the amount of interest you pay. Do you need a cosigner? Are you prepared to pay administration or processing fees? How much are the fees and what are they for? And lastly, should you take insurance on the loan? Optional creditor insurance is often available. Insurance coverages can include things like life, disability, critical illness, and involuntary unemployment. There are different types of loans for different types of borrowers' needs. For the next few minutes, we will discuss the differences among these types of loans: lines of credit and personal loans. The basic features of a line of credit include revolving funds. You can withdraw the money as you need it, pay it back, and borrow it again if you need to. You don't have to borrow all of the funds in advance. Use it for emergencies, delayed payroll. The second feature, no withdrawal, no interest due. You only pay interest on the amounts that you've withdrawn, or the balance. If you don't use your credit line or line of credit, there is generally nothing to pay. Some financial institutions do charge a monthly fee even if you don't use it. This is sometimes called a standby fee. Check with your financial institution to see if this is something that is charged. And lastly, interest is calculated daily and charged monthly. Interest is due on the amount withdrawn for the number of days it's used. The best way to use a line of credit is to pay it back as soon as you have the funds to do so. Time for a question. True or false? Interest rates on personal loans are generally half of the interest rates on credit cards. The answer here is true. A personal loan is a really good alternative to credit card debt. Personal loan rates average between 5 to 10% depending on the loan and your credit rating. Credit cards range from the low interest side at about 14% up to as high as 24%, averaging around the 20% mark. So for personal loans, what should you consider? First, interest rates. What kind of interest rate will best suit your borrowing needs? A fixed rate that will stay the same for the duration of your loan, or a variable rate that will change as the prime lending rate changes? Installments. Loan durations can vary greatly from 6 months to 7 years. How many installments will you be required to cover during that period? How often will you make your payments? And how do the different payment periods affect the overall amount of interest you'll pay? And lastly, insurance. Will you insure your personal loan against death, disability, critical illness, loss of employment? It's important to consider how you will continue to pay your debts in case of an emergency or unforeseen change in your life. Another question. True or false? A consolidation loan would be bad for my credit rating since it shows that I didn't use credit wisely. This is actually false. Failing to meet your debt obligations, for instance, failing to make those monthly credit card payments, will negatively impact your credit. A consolidation loan helps you make your monthly payment and reduce your debt more quickly. A debt consolidation loan is a single loan that allows you to repay your debts to several or all of your creditors at once. You are then left with one outstanding loan to the financial institution. It allows you to bring together all of your debt under one monthly payment and one interest rate. If you find yourself in a tough situation, no judgment. It may be a good idea to consider using a consolidation loan to bring together or blend many loans and debts into one easy-to-manage loan payment. To get a consolidation loan, you need to apply for one. The process of applying for one is much the same as applying for a regular loan. The slide demonstrates the relative costs of a $10,000 loan at 19.99%, amortized over 4, 3, and 2 years. Each column displays how the choice of amortization period affects both the short term, how much you pay each month, and the long term, how many months you pay and the total interest cost. A long amortization may help reduce your monthly payment. However, it will cost you more over the long run. A short amortization will result in higher monthly payments, but will reduce the overall cost of your loan. As a financial consumer, you have specific rights related to your personal loan, mortgage, and lines of credit. For the most accurate information regarding your rights, it's best to consult the Financial Consumer Agency of Canada and or the Manitoba Consumer Protection Office website. Some tips include, if you are transparent with your financial institution, you should expect the same from them. Also, there are no silly questions. Answering your questions about your loan and the loan process in general is the job of your financial institution and its representatives. Don't ever feel too intimidated to ask questions. Asking questions may save you time, money, and frustration. Regardless of the reasons that a person is turned down for a loan, being turned down doesn't always have to be the end of the story. If you've been turned down for a loan, there are still things you can and indeed should do. First, ask why your loan was denied. A creditor may make a decision to turn you down for credit based on a variety of reasons, but it is your right to know why your application was declined. 2. Review your credit report. If at least part of that decision was reliance on a credit report, then they must tell you this, including the name of the credit bureau used in the decision-making process. You can then contact that credit bureau and request a copy of your report. 3. Consider a cosigner. Consider asking someone you were close to and who has a good credit rating if they would cosign the loan with you. Sometimes having a cosigner with a good credit rating may provide the bank or credit union with assurance that they will be repaid. 4. Consider a lower loan amount or a longer repayment period. If you can get a loan for a lower amount, carefully consider if that will be of benefit to you or if it will only cause more financial trouble in the future. As always, if you have questions or would like more information, please reach out to your financial institution for assistance.